Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. When you invest in an equity mutual fund scheme, then there are two ways in which you can beat the market. Either the fund manager that you are investing with has his portfolio or her portfolio fall less than the market when the market is falling, or they have their portfolio rise more than the market when the market is rising. There's an interesting way to capture both of these figures or metrics. But the question that I'm asking is it better to invest in a scheme that consistently falls less than the market, or is it better to invest in a scheme that outperforms the market over the long term? Which performs better? Which gives you better rolling returns? That's a question that I asked Rushabh Desai, who's the founder of Rupee with Rushabh Investment Services. Rushabh, we decided, and first of all, thanks so much for joining me on today's conversation, but we decided to stick to Flexi Cap as well as Midcap and Small Cap. What does the data throw up? Is it better to invest in a scheme that falls less than the market, or in a scheme that does better than the market when the market is rising?
Hi, Alex. First of all, thanks so much for having me on the show. Ideally, one should be looking at a higher upside capture ratio and a lower downside capture ratio, right? So what it means that if the base of the both of these ratios is 100, so I would prefer to invest in a fund which has a upside capture ratio of greater than 100, right, and a downside capture ratio of less than 100. What this simply means is that when markets are in a bull run, right, the higher upside capture ratio fund will generate higher returns than the benchmark, than the market. And during bear markets or during markets when they are highly volatile, a lower downside capture ratio means the fund will fall less than what the market is falling. So if the market is falling, say, minus 10%, the fund will fall probably, say, minus 8 or minus 5 or minus 4%, right? So now, ideally, I would prefer to go for a fund which has a higher upside capture ratio and lower downside capture ratio. This is number one. Number two is that, see, if someone is looking for an aggressive bet in the equity markets, then of course we have seen higher number of bull cycles compared to bear cycles. So I would still prefer to go for a fund which has a higher upside capture ratio. Okay. But at the same time, we have also seen funds, say, for example, like Parak Flexi Cap Fund, which does not have a higher upside capture ratio. The upside capture ratio is 93 and the downside capture ratio is just 30. But that particular fund has done well in terms of rolling returns in many market cycles as well. So I would ideally prefer to go for a fund which has a higher upside capture ratio and a lower downside capture ratio, Alex.
Does that change based on the scheme category? And let's look at it individually, right? You've already mentioned a couple of schemes from the Flexi Cap category, and one of them is the PPFAS Flexi Cap Fund, which incidentally had a lower upside capture ratio when we checked it a few months back. Because of the amount of cash that they were holding and because of where the markets were. So these metrics can be quite dramatically fluctuating depending on the time frame that you look at it. But having said that, what were the key takeaways for you in the Flexi Cap category?
See, Alex, number one is that active funds have done quite well compared to the benchmark in terms of consistency. So active funds in the Flexi Cap category, the top 5 funds have, so I took out data for the past 3 years from 2022, 28 November 2022 to 28 November 2025, right? And I pulled out 5-year daily rolling returns. And I wanted to see which all funds have generated greater than equal to 15% compounding returns over the past 3 years, which I just mentioned, right? So there have been 5 funds which have done phenomenally well. One is Quant Flexi Cap Fund. Second is, which I mentioned earlier, Parak Flexi Cap Fund. Third is the PGIM Flexi Cap Fund. Fourth is the HDFC Flexi Cap Fund. And fifth is the JM Flexi Cap Fund. Now, all of these 5 funds have delivered greater than 15%, greater than equal to 15% compounding returns, 80% to 100% of the time period over the past 3 years. So which clearly means, and And at the same time, the Nifty 500 TRI index has only generated greater than equal to 15% CAGR return 72% of the time period of over the past 3 years. So this clearly means, number one, that active funds have managed to deliver consistent returns. Number two, many of these funds have also outperformed the benchmark. So number one, consistency plus outperformance. So outperforming consistent funds is something what I have observed over the past 3 years, Alex.
Okay, interesting. But to the argument that I was making, that it seems like betting on a scheme that protects your downside when the market is falling, which seems to be what Parag Parikh has done, its downside capture ratio is 30, which means that if the market falls 10, then it is falling only 3. So it's not necessarily true that all schemes will have a similar profile, right? Because one thing that has worked in their favor is the kind of orientation that they had and the exposure that they had, which has dwindled, of course, Rushabh, over the last 1.5 years in international equity, right?
Absolutely, Alex. So I think diversification is the key. See, if you want to minimize, see, you cannot avoid underperformance risk. Okay, let's beat the fact. Okay, you can only minimize the underperformance risk. See, if I'm investing in an equity product, right? I would want outperforming returns over and above the benchmark on a longer period of time. See, what I pulled out is just a 5-year return, right? I mean, these consistent performing funds is not equal to outperforming funds. Okay, funds will underperform from time to time. Let's beat the fact. But yes, I mean, as I mentioned earlier, that I would want to bet on a fund ideally which has a higher upside capture ratio and lower downside capture ratio with the higher consistency which delivers greater than equal to 15% CAGR returns.
Okay. Now we venture into the broader market funds where generally you see higher volatility, Rushabh, just purely because of the nature of the schemes that and what they're investing in. But what are your takeaways from the mid-cap space where you have similar results as well, right? Where the mid-cap index, that is the benchmark index, has done better than 15% compounded over and 83% of the time over the last 3 years, which is incredible in and of itself, which is why a lot of people are arguing for going towards the passive route when you're talking about the mid-cap space.
See, I truly believe that there is ample of opportunity for mid caps and small caps to outperform the benchmark. Okay, uh, I mean, the large cap universe is unfortunately quite restricted, right? But at least I feel in the mid and small cap space, because it has a more universe, a larger universe base, and the mid cap companies, the mid cap funds can also invest a good portion into the small cap segment as well. So I truly feel that mid and small caps active funds will do better compared to the benchmark. Number two is that, see, choosing a fund based on one consistency rolling returns over the period of 5, 7, 10 years is very important. And no, number two is something what I would look at is that how much is that fund able to outperform the benchmark. So consistency and outperformance is something what I would look at. I'll give you a very small example, Alex. See, a couple of years back, Motilal Oswal Midcap Fund didn't do that great. Okay, but today, since in 2025 and a little bit of 2024 as well, Motilal Oswal has been the best performing mid cap fund in the market, right? So I feel diversification is the key, Alex. Diversification across different market capitalization, which is large cap, mid cap, small cap, diversification across different funds, different AMCs, and most importantly, different styles. A lot of people don't understand that there are four styles in the market. One is growth, value, contra, and momentum. So I think all of this put together, if one diversifies well into quality, consistently outperforming mutual funds, then they would be able to protect their portfolio from, or minimize the underperformance risk, Alex.
Okay. Having said that, I'm looking at the metrics for the mid-cap space that you've shared with me, and it's not necessary that a scheme that is done incredibly well and has the best upside capture ratio, in this case Motilal Oswal 160, and downside capture of 72, which means that it's falling less than the market as well. But there is inconsistency of return, relatively speaking. It has delivered a 15+% CAGR over that time frame 89% of the time. Whereas a PGIM or a quant, which has worse metrics on both upside and downside, have delivered that 15%, 100% of the time. Why is that?
See, what happens is that sometimes fund manager calls can take a U-turn or can go wrong, right? I mean, see, quant has, see, what we are seeing is, let's not forget a 5-year return, Alex, okay? So a 5-year return is going to look much more better compared to the 1-year return over the past or in 2025 when, currently as we are in a time correction. So over the past 1 year, say for example, funds like Parak Flexi Cap Fund, funds like quant funds, right, have actually underperformed the market. Now this is a short-term underperformance, Alex, right? So sometimes calls can go wrong or calls can take a U-turn, right? But if you look at the longer picture, if the philosophy of the fund is intact, if the fund manager knows what he's betting on, and of course the fund manager is not going to bet on a stock for the short term. Of course he or she is going to bet on a stock for the medium to long term, Alex. Let's not forget that. So these are 5-year rolling returns. That is why you are seeing good amount of consistency and outperformance. But for example, if you look at 1 year, 1.5 year, quant and Parak have actually underperformed. So just bet on the medium term to long term story of these funds and bet on quality funds. I think the investors should do better.
Okay, just a couple more points, and let me run through the list that you've shared with our viewers, because ultimately this is going to be a similar observation, Rushabh, for the small cap category as well, unless you have certain observations. The top of the list is Axis small cap as well as quant small cap in terms of consistency of return, where you have 100%, and we'll show the graphics of this while I'm speaking about this, but you have 100% of the time they've delivered a 15% compounded annual growth rate or more than that. And they've got pretty decent upside capture ratio and downside capture. Downside capture of less than 100, remember, is what is good. And you have Nippon India, which I think is the most popular small cap fund by far. It certainly has the most assets under management, which has 94% of the time delivered a 15+% compounded annual growth rate. Also pretty decent upside and downside capture ratio. And they've actually done better than the benchmark as well, which in this case is the Nifty Small Cap 250 Total Return Index. But Rushabh, a key takeaways from this, ultimately a viewer would want to know when they are making their own selections, how do they do that, and what do you like from the schemes that we've discussed?
Okay. See, Alex, what you just mentioned, for example, say Axis small cap and quant small cap funds, which have been the top consistent performing funds on a 5-year rolling returns basis, right? But at the same time, both of these funds I have underperformed over the past 1.5 years. So these are historical past returns. What we need to look at is that from today, which funds have the capacity to do well over the next 3, 5, 7, 10 years, right? Now, it's very difficult to actually predict, right? You cannot actually predict which funds will do well, which funds will not do well, right? Now, again, the key is to diversify well across different market caps and different categories and funds. That is what I would recommend. The key observations I have noticed in all of these 3 categories is that flexi cap, mid cap, and small cap put together, growth oriented and blended strategy funds have done well. Parak Flexi Cap is an exception at this point of time because it follows a value oriented strategy and they have done a phenomenal job. But overall, most of the funds in these 3 categories have done. I mean, particularly growth oriented and blended strategy, which includes growth and value both, have done well, Alex. So this is the key observation in my humble opinion. And I like 3 funds which I feel that could do well over the next 5 years. One is that Parak Flexi Cap Fund will continue to do well. That is what I feel over the medium to long term. Number 2, Motilal Oswal Midcap Fund. And number 3, Kotak Small Cap Fund. So these are the 3 recommendations I have from each of the category.
Got it. Rushabh, thanks so much for taking the time. Pleasure speaking with you as always.
Thank you so much, Alex.